There are four main financial statements. The balance sheet basically tells you what a company owns and owes at any specific point in time. Then you have the income statement, how much money a company made and spent over a short period of time. The cash flow statement, the exchange of money between the company and the outside world over a specified period of time. And finally, the statement of the shareholders' equity. This shows changes in interest of the company's shareholders over a specific period of time. When people mention financial statements, they also mention balance sheets. What are balance sheets? They are date specific. They include your assets, liabilities, and your shareholders or owners' equity. Assets are things that the company owns that have value. This can be products or services. Liabilities. Liabilities are amounts of money that the company owes to others. Shareholders' equity. Shareholders' equity is sometimes called capital or net worth. It's the money that would be left if a company sold all of its assets and paid off all of its liabilities. This leftover money belongs to the shareholders or the owners of the company. The balance sheet usually has assets listed based on how quickly they can be converted into cash. You have current and non-current assets. Current assets may be converted into cash within a year, a relatively quick time period. Non-current assets, or fixed assets, may be a little bit more difficult to turn into that cash. Usually, at the right side or the bottom, you can see the liabilities and the shareholders' equity. Then, on the top or left, you'll see assets. And remember, assets basically are the combination of liabilities and the shareholders' equity. Liabilities are your organization's debt. They're usually based on their due date, and there's current and long-term liabilities. Current liabilities usually include accounts payable, notes payable, accrued expenses, taxes, and usually a current portion of your long-term debt. The current liability account will show the amount the company owes for items or services purchased on credit and for which there is not a promissory note. This account is often referred to as trade payables, as opposed to notes payable, interest payable, etc. Notes payable. This is the amount of principal due on a formal written promise to pay. Loans from a bank may be included here. Your accrued expenses reflect the estimated amount a company owes for expenses that occurred but have not yet been paid for nor recorded through a routine transaction. Next, we're going to talk about shareholders' equity, which is the amount the owners invest in a company's stock, plus or minus the company's earnings or losses since the inception. An easy equation to remember this by is equity equals the total assets minus the total liabilities of the organization or agency. Remember, a balance sheet shows a snapshot of a company's assets, liabilities, and shareholders' equity at the end of a reporting period. It does not show the flows into and out of the accounts during that period. Next, we'll talk about the income statement. The income statement shows how much revenue a company has earned over a specific period of time and the costs and expenses associated with earning that revenue. Basically, it shows the company's net earnings or losses. Then we have reports of the earnings per share, and this is how much money shareholders would receive if the company decided to distribute all of the net earnings for the period. To understand how income statements are set up, think of them as a set of stairs. You start at the top with the total amount of sales made during that accounting period. Then, as you go down, one step at a time, you take a deduction for certain costs or other operating expenses associated with earning the income. At the bottom of the stairs, after deducting all the expenses, you learn how much money the company actually earned or lost during the accounting period. People often call this the bottom line. When you discuss a cash flow statement, you are reporting a company's inflows and outflows of cash. Why is this important to know? Well, a cash flow statement shows changes over time rather than an absolute dollar amount at a point in time. They're usually divided into three parts, consisting of the operating, investing, and financing activities. While an income statement can tell you whether a company made a profit, a cash flow statement can tell you whether the company generated money or generated cash. As previously mentioned, there's three activities mentioned in the cash flow statement: operating, investing, and financing. If a company buys a piece of machinery, the cash flow statement would reflect this activity as a cash outflow from investing activities because you used cash. If the company decided to sell off some investments or that piece of machinery, the proceeds from the sales would show up as a cash inflow because it provided cash. To give you a hint, you'll want to read the footnotes within the cash flow or income statements. They'll include four main areas. First, the significant accounting policies and practices notes. Basically, companies are required to disclose the accounting policies that are most important in how the company's financial health and condition is portrayed. Next, income taxes. The footnotes will provide detailed information about the company's current and deferred income taxes. These may be broken down by a level, such as federal, state, local, or maybe even foreign, and the main items that affect the company's effective tax rate should be described in detail. Third, pension plans and retirement programs. Here, the note should discuss the company's pension plans and other retirement or post-employment benefit programs. The note should contain specific information about the assets and costs of these programs and indicate if these programs are under or overfunded. Finally, stock options. The notes should contain information about stock options granted to officers and employees of the company, including the method of accounting for stock-based compensation and the effect of the method on reported results.